This is the Savvy Investor radio show and podcast. For help with your retirement, schedule a 15-minute phone conversation with the team at ProStatus Financial Advisors today. Just call 866-597-1040 and at thesavvyinvestorradio.com.
Welcome back to the Savvy Investor radio show and podcast with the team at ProStatus Financial. Mike Kinnett is here. Ryan Herbert is here. My name is Randy Cook, and we talk about the issues of retirement. What's on your mind? What are you questioning? What are you concerned about? Let's get it all out on the table. And one of the things that we worry about an awful lot is my money in the right place? So, Mike, we're going to talk a little bit. I found this very, very interesting. They're starting to look back at the people who were successful last year in 2025. And as they did, they took a look at portfolios that were built for growth and portfolios that were built for retirement. You would think that the ones that were built for growth did really, really well, and they did. But according to this article here, the retirement model portfolios did even better. And they said it was because of that big word, diversification. And they gave some examples. A retirement portfolio that had 5% of this, 10% of that, 5% of this, 10%. It was very, very spread out. And that really apparently worked really well last year. Do you think that this is an anomaly, or is a retirement portfolio something that other people should probably model?
No, I think retirement planning and having a plan is the key to any successful retirement. Mm-hmm. You know, obviously, we've all heard of diversification, right? And a couple of guys driven by this economist named Markowitz back in the early 50s, They came up with this notion, and basically it says if you diversify your investments along non-correlated asset classes, you'll increase your overall returns and decrease your risk. And flash forward, over the next 30, 40, 50 years, it became kind of the institutionalized approach of diversification. As a matter of fact, I think sometime in the 1990s, he actually got a Nobel Prize for, I think if I had to kind of just summarize it real simply, he got a Nobel Prize for saying, don't put all your eggs in one basket. And that makes perfect sense. It really does. I get the idea of it. But the problem with this diversification concept is that diversification, at least on the Markowitz side of things and how most of our industry does this, diversification is based upon 1950s thought process where the world was really diversified. Well, in 2008, everything crashed. In 2020, everything crashed. 2022. I mean, even your fix crashed in 2022. So while the concept of diversification absolutely is paramount, I think it has to be explored in a bigger picture, meaning, yes, you want your investments diversified. Yes, you want your income diversified. So we don't want to put all our eggs in one basket when it comes to, I don't want to buy just 3 stocks. I don't want to buy just, have one source of income. And you have to diversify your tax planning strategies. So yes, diversification matters, but I think diversification when you're working with somebody that is focused on grow, because that's what probably, and this is just a made-up number on my part, but I don't know, probably 90% of our industry is focused on that first part of your life, that phase 1 part of your life where it's all about grow. And they don't really think about the tax implications or how we're going to distribute it or how we're going to create income streams. That's so far down the road for them, they don't think about that. Well, Ryan and myself and our team, we're phase 2 fiduciaries, where all of a sudden, yes, diversification is important, but diversification isn't all about grow. It's exactly what you started the conversation with how are we going to do this in such a way that not only are we growing the funds in a way that makes sense, but we're doing it in a strategic way that maximizes upside, but also minimizes the downside, right? And, I understand past performance is no indication of future results and all that type of stuff. And, individual investments vary for individual investors. But, looking back at our portfolios in 2022, frequently when you looked at their total portfolio, somebody in that 60-40 range of allocations, a lot of people experienced, not that 10 to 20% on the fixed side losses and the 20 to 30% on the growth side, but, much more palatable losses given the fact that they were in the market. I mean, less than 10% when you looked at everything, and losing less than 50% of everybody else, just like we did in 2008. That's an attractive way, but it wasn't because we had 20 mutual funds or 20 ETFs that were diversified. It was because we had a strategy on the diversification of the investments, but the diversification on when is the right time to be where we are, a strategy about what sectors to be in, a strategy about what fixed income and safe money actually means, a strategy about how our income play is going to come in so we're not draining our accounts during down markets, a strategy on the tax implications so we don't, think about this. If you need $100,000 to live on and you're working with us, we only have to create $100,000. If you're working with the average advisor, you have to create $130,000 to wind up with $100,000. So how much more risk do you have to take? So yes, diversification is important, but I'm always nervous when I hear that because I think people think diversification just really means don't put all my eggs in one basket. And yes, that's true, but that's not 100% true.
Yeah, I mean, it really goes down to one thing that we always say is you take as much risk as you need to take to accomplish your goal. And most people, when they think about investing, they think about the stock market, they think about growth. Most baby boomers think about the stock market of what it did in the 80s and 90s is it always goes up. And in recent years, it has been going up. We have these short-term pullbacks, but overall, it does continue up. And it's just like Mike said, most people have that thought, or they're working with a phase one advisor where their focus really just is grow the money. Nobody really ever has this mindset shift of, now I need to preserve and protect the money. Yes, it does happen with the notion of now that I'm retired, I should become much more conservative. But, just the other day I had a couple come into my office and they were asking me about returns. That's all that they wanted to talk about was show us your past performance, show us your returns. We're in between advisors. We have 3 separate ones right now, and we're just, we're comparing them. And this one's not doing as well right now as that one, but he did better in the previous year. And they're going through all these different iterations of these portfolios. And I said to them, what's the overall goal of this money between, your pensions? You both worked for the federal government at some point, and then you also both work for the state government. One of them worked for the school system. You guys have all these pensions. You guys have Social Security. You have more than enough income coming in. What's the overall goal of this money? And they really couldn't say, we want this money to do X. We want this money to do Y. We're leaving money to our kids. We want to buy an RV. And, what I gathered from them is what they have been doing over the years is they have been going to advisors and basically telling that advisor, hey, I have a better part of $5 million. I'm going to give you $500,000, $800,000. I'm going to give you $1 million, and I'm going to compare you to this advisor over here who has the same amount of money. And I'm going to compare you to what I'm doing in my 401k.
We call that stupid. Yeah. Go ahead. I'm sorry. Go ahead.
And what they're essentially doing, and I, in a polite way.
So that's what happens when we get older, Randy. Yeah. We say stupid.
In a polite way, what I explain to them to do is you're not really creating any type of financial strategy because you're going to these advisors whose goal is to get as much of the assets as they can underneath of them so they can charge the fee so they can make more money. What you're telling them is swing for the fences every single year. Mm-hmm. I don't care what the market looks like. I don't care what you think. Swing for the fences because at the end of the day, I'm going to compare you to this guy. And if you think that a 60-40 portfolio, if that advisor thinks a 60-40 portfolio is appropriate for them at their stage of life, well, if the other advisor is 100% equity, he's going to lose because that guy's 100% equity, assuming the market's going up. He's going to lose because that account's going to outperform. And then they're coming to me and they're asking me about returns. And my whole strategy was, if all you're doing is asking me about returns, I'm only going to show you the most aggressive portfolio I have that has the highest returns over the years. It's not really a reflection.
Cherry picking.
Mm-hmm. It's not really a reflection of how well or how poor that advisor is doing or how well or how poor we would do, because all you're asking me to do is be a home run hitter. And who's the name of the Orioles home run hitter? And I can't remember his name. He was
Brady Anderson.
Brady Anderson. He struck out a lot over his career. He hit a ton of home runs. Same thing with Sammy Sosa and Mark McGwire. They hit a lot of home runs, but if you look at the home runs, they had a lot more strikeouts than they did home runs. And that's not the way to approach retirement planning. It's not the way to approach retirement investing when you're in your 60s and 70s and 80s. What is the overall goal with the money? If you just want to earn 5-6% of your money, stay on pace with inflation, and leave behind a sizable nest egg to your kids, why are we swinging for the fences? Why not take a much more balanced approach?
Okay, and you know what? None of those home run hitters are going to make it to the Hall of Fame because they got all sorts of hiccups along the way, didn't they? Right? I'd rather make it to the end. I want to make it to the Retirement Hall of Fame. As a retiree, I want to make it to the Retirement Hall of Fame. I don't care about home runs.
Yeah, and it's really one of those things, like I said, is you take enough risk to accomplish your goals. Certainly, if you have I'm going to call it a pie in the sky retirement dream, and you need 10, 15, 20% returns on your money to make that retirement happen, well, number one, maybe we're not the best fit for you. But yes, you do need someone who's going to be swinging for the fences every single year. But the way we approach retirement planning is the number one step is making sure you have your income is as safe and secure as possible. Because once we make sure that you have the income that you need coming in every single month, whether the stock market is up 20% or down 20%, the amount of risk that you can take on with the rest of your money, you can be super aggressive with that money, because if the stock market goes up 20%, you make 20%.
Home run.
Conversely, the stock market drops 20%. I'm not happy because I've lost 20% of my money, but I took the steps to make sure I have the income I need. That 20% drop in the market doesn't change my day-to-day spending, just like that 20% increase doesn't affect my day-to-day spending. If your goal is I have my income secure, right now we have about $2 million for the, adjust for inflation, keep pace with inflation, adjust for taxes a little bit. I want to leave about $2 million behind to my kids. It's a much different story. You can take a much more balanced approach. Everybody's situation is different, and that's the true value of retirement planning. Is it's not swinging for the fences every year. It's trying to hit singles, doubles. Every once in a while you can hit a home run, but getting on base is what you should be looking for in retirement.
You're listening to the Savvy Investor Radio Show and podcast with the team at ProStatus Financial. To sit down with the team and talk through your retirement issues, take a look at our website, which is thesavvyinvestorradio.com. There's some buttons there. It says schedule a call. There's another tax analysis button there, whatever you're interested in. To sit down and really schedule a time to really crunch some numbers and talk about your retirement. It's a no cost, no obligation look at your retirement. It's basically a phone call to get your questions answered. Check it all out on the website. We have notes in the podcast as well here, thesavvyinvestorradio.com. There's also another way that you can contact us, which is our special website we just put together. It's called askmikeradio.com. That's a website where you can just ask a question of the team, and we'll answer it right here on the radio show or podcast. Again, askmikeradio.com. You can also give the team a call at 866-597-1040. That is all the time we have today on the Savvy Investor Radio Show and podcast. We appreciate you listening. Ryan will give you the last word on this one.
This is Ryan Herbert. Thank you so much for listening to the Savvy Investor Radio Show and podcast.
And this is Mike Kinnett. We'll see you, the Savvy Investor, next week.
Advisory services offered through ProStatus Financial Advisors Group, a registered investment advisor. Insurance licensed in Maryland. ProStatus Financial Advisors Group, LLC is not licensed in all 50 states. To find out if ProStatus Financial Advisors Group is licensed in your state, please call 410-863-1040. ProStatus Group, LLC is not affiliated with nor endorsed by the Social Security Administration or any other government agency and does not provide legal or tax advice. Annuity guarantees rely solely on the financial strength and claims-paying ability of the issuing insurance company. By contacting us, you may be provided with information about insurance and annuity products offered through representatives of ProStatus Financial Advisors Group.